Hey, it's Stuart. Today's listener question is from Kyran, and it's a really long question, but essentially, Kyran is asking us, how do we plan around land tax? And Kyran's suggesting that he's got a property in Brisbane, an investment property that is, and he's considering, do I buy another one in Brisbane or do I buy another one in Melbourne? And what are the land tax considerations? It's a really important question because land tax is quite insidious in that it creeps up on you and it starts to become a problem, after you've owned the property for a few decades, particularly more than one decade. Because obviously, if you've bought a good quality asset that has a strong land value component, the land value part of the asset starts to become considerable after many years of compounding capital growth. Now, that's great from a wealth perspective, but not so great from a land tax perspective. Now, it's not something that we necessarily really think a lot about when we buy a property. I mean, we should, and this is the whole point of this answering this question, but quite often investors don't. So then how do you weigh it up? Because what you need to do then is work out, what do I think the land value proportions, the unimproved value of this asset, what do I think it's going to be in the future? And you've got to make some assumptions around the overall growth rate of the value of the property and then the proportion of that value that is represented in land. And then the second thing you need to make some assumptions around is, how will land tax rates change over time? So New South Wales used to index their land tax free threshold. They've stopped doing that, although their land tax free threshold is relatively high compared to other states. So it's not such a big deal. Victoria has been reluctant to, change or index its marginal land tax rates for many years. So you get that bracket creep, of course, notwithstanding, of course, Victoria has just introduced an additional levy, land tax levy on investors. Well, we've got to make some assumptions here. Now, I'll explain what we do. We use the current land tax rates, but we index them. So, because if you don't index them and you apply, say, a 7% capital growth rate to a property, you're going to end up paying a ridiculous amount of land tax. But if that property is pretty close to the median house value, the reality is you're probably not going to pay a lot of land tax. I mean, if you've got a median house value asset over time, the tax legislation typically will be aimed at not taxing or overtaxing those landlords, but landlords that have huge land holdings. So indexing the marginal tax rates is the way to go, and which is what we do. So we look at what is the future value of the property, we discount it back in today's dollars, accounting for inflation, and then we apply the tax rates. It's kind of our best guess in terms of what land tax might be, but it's really important then to model. If we've already got a property in Queensland, we add an additional property, versus even acknowledging the land tax is higher in Victoria. If we don't have an asset there, in the long run, we're going to pay less land tax. And that might be the case in some scenarios. And you want to find that out today when you're making the decision where to invest, rather than find out through experience in the future by making a mistake and then being stuck in a situation where you don't want to sell the property because it's performing really well. And you don't want to sell the property because you're going to crystallize capital gains tax. So you're kind of stuck in this situation of having a great asset, but you're paying a lot of your income out in land tax. It's not ideal. Look, we're never going to necessarily avoid land tax completely, but I think it's a really important thing to think about, aspect to think about when we're constructing a property portfolio. And I should say it's only one of many things. So I'm not going to construct a property portfolio solely on the basis to minimise land tax. We've got geographical diversification, capital growth, spreading returns, different price points, different types of assets. There's a lot that goes into constructing our property portfolio. Land tax is only one of those things. But great question, Kyran, and hopefully that sort of explains a little bit our approach in terms of balancing out these things and considering land tax for property investors, particularly as they grow a property portfolio. If you have any other questions that I can answer in the podcast, you can send them to, or feedback, you can send them to me at questions@investopoly.com.au. We'll put that on the screen, and we look forward to answering your questions. Cheers.